In the last video, I introduced you to a strategy that the wealthy have been using quietly for years here in Canada, the capital control system. I showed you how it flips the script on traditional banking and taxes. But today, we're going even deeper. In this video, I'm going to walk you through exactly how to set it up, how it works behind the scenes, who it's for, what it costs, what happens if you can't pay, and how it's compared to things like RRSPs and TFSAs. Just saving your money in your business account. I'll even break it down with real-life numbers so you can see how powerful this is. Let's start with a 30-second recap of the capital control system for those who are new. It uses a high cash value life insurance policy built specifically for cash accumulation. You can borrow against it at any time without interrupting growth. You become your own source of financing, whether for investments, vehicles, emergencies, or business needs. The goal isn't to buy life insurance. The goal is to create a financial engine that gives you access, control, and tax-free growth, all at the same time. Let me break it down step by step. Step 1. Work with a licensed advisor who understands this strategy. Not every advisor is trained in this, and a poorly structured policy just won't work. This is a custom design process. Step 2, decide how much you want to contribute. You can start with as little as a few $100s a month, or structure it to six-figure annual contributions. The key is flexibility and long-term intent. Step 3, get approved. Since this is a life insurance product, there is medical underwriting. But even if you're not in perfect health, there are ways to structure it with other family members or a corporation. Step 4. Fund the policy. Your money starts growing tax-free right away. And depending on how it's set up, you can often borrow against it within the first year. Step 5, use the money strategically. You can borrow against the policy and use it for investing in your business, buying a property, paying off high interest debt, and taking advantage of opportunities. And while you're using that money, your full cash value keeps compounding in the background. That's the magic. Let's walk through a detailed example so you can see how this plays out in real life. Imagine Sarah, a tattoo shop owner in BC. She earns about $120,000 a year, and she wants to start earning long-term tax-free wealth. She decides to set aside $1,000 per month into her capital control system. Year 1, she contributes $12,000. Cash value at the end of year 1 might be around $9,500 or $10,500 depending on the policy design. She already has access to borrow around $7,000 or $8,000 if she wants. Year 3, she contributed $36,000. Her total cash value might be around $30,000 to $33,000. Let's say she borrows $25,000 to invest in new equipment and rebrand her shop. That money goes directly to her. No credit checks, no banks involved, and no taxes because it's a loan, not income. Now let's pause for a second. A lot of people ask, wait, why is there no tax on that $25,000? When you take money out of most investments, like an RRSP, it's considered income and it's taxed. But when you borrow against an insurance policy, it's not income, it's a secured loan. Since you're technically using your policy as collateral, there's no tax event. Just like a home equity line of credit doesn't trigger tax. She pays simple interest on the loan. What does that mean? Simple interest means you only pay interest on the original amount you borrowed. If she borrows $25,000 at 5%, she's paying about $1,250 a year in interest. She can choose how and when to pay it back. Or just let it sit and be deducted from the death benefit later on. Now, why is this powerful? Because simple interest is often much cheaper than bank loans, lines of credit, or credit cards. There are no credit checks, no repayment schedules, and she's still earning interest on the full $30,000 plus inside of her policy. This is exactly why the rich people use borrowed money to make money. They keep their cash growing in tax-advantaged places. They borrow against it to invest and grow their business. And they use leverage as a tool to multiply their returns so they never interrupt their wealth-building engine. Year 5, she now contributed $60,000. Her cash value could be around $55,000 to $65,000. Even if she has a loan outstanding, her policy keeps growing. So now she has the ability to borrow again, use the funds again, or just let the policy grow untouched. Now here's the best part. All this growth has been tax-free. She didn't have to sell investments or report income to access her cash. And she's still protected with life insurance that would leave a legacy for her family. And over time, that policy will become a tax-free retirement income stream she can borrow from for life, or pass on to her children with no tax. That's how the wealthy use life insurance in Canada. Not just as protection, but as a financial system. Here's some of the most common questions that I get. Is this legal? Yes, This strategy has been used in Canada for decades. Banks, wealthy families, and even corporations use it. It's all within Canadian tax law. What if I can't repay my loan? No problem. The loan is backed by your policy. If you pass away with a loan balance, it's simply deducted from the death benefit. What if I don't qualify? If you have health issues, you can insure a family member or use a corporate-owned policy. There are options. How is this better than an RRSP or a TFSA? RRSPs defer taxes. You still pay later. TFSAs have limits, and they don't give you access to leverage. The capital control system gives you both, growth and control, without tax traps. Let's say you're a barber or business owner saving money in your corporate account. That money's taxed inside the corp if it's earning interest. If you take it out, you pay personal tax again. With the capital control system, you grow the money tax-free. You can use it personally or for the business. You avoid double taxation, and your wealth passes tax-free to your family if it's set up right. This strategy is perfect for business owners with surplus cash, barbers, tattoo artists, and independent creators, adult entertainers and influencers with unpredictable income earners who want privacy, control, and tax efficiency. And yes, it works for incorporated and unincorporated individuals. There's personal and corporate versions of the strategy. Every single policy is custom. There's no one-size-fits-all here. This is why I offer a free strategy session where I sit down with you, go over your situation, your income, your goals, and help you map out exactly how this can maybe help you. Click the link in the description to book your call. No pressure, no commitment, just clarity. Let's take back control of your capital. If this video helped you understand the capital control system a little bit better, give it a like, subscribe, and leave a comment below if you want me to dive deeper into case studies or breakdowns. I've got more real Canadian wealth building content coming your way. See you in the next one.